It's an honor for me to welcome our distinguished speaker and the participants. As we gather today for another enlightening session on the NAFRA webinar series titled Thinking Audit, Not Taking Audit, on behalf of the executive body of NFRA, it's my honor to extend a warm welcome to each one of you. Today's webinar marks the third one in our ongoing series. We're happy to delve into a topic of paramount importance: inventory and receivables, mastering best practices. This session promises to offer insights and strategies that are indispensable for navigating the complexities of financial auditing. We firmly believe that auditing is not merely about ticking boxes or meeting statutory obligations. Instead, it is a dynamic and multifaceted discipline that demands keen insight, rigorous analysis, and unwavering integrity. It is about identifying risks, meticulously evaluating them, and providing stakeholders with actionable insights that drive informed decision making. Today, as we focus our attention on inventory and receivables, we are reminded of the critical role these assets play in the financial health and sustainability of the organizations. By learning the best ways to handle and check these important parts of financial records, we can lower risks, make things clearer, and uphold the highest standards of financial integrity. We have the honor of hosting distinguished speakers who are experts in their respective fields. They will generously share their knowledge, expertise, and valuable insights, which will not only enhance our comprehension, but also motivate us to enhance the audit practices. It's my privilege to introduce the speakers to today's webinar. Firstly, we have Mr. Anand Subramanian, partner at Deloitte Haskins and Sells LLP. Mr. Anand brings with him a wealth of expertise with 21 years of experience in the field. Based in Bengaluru, he is a chartered accountant specializing in various international reporting, accounting standards, including IFRS, Ind AS, US GAAP, and SEC reporting. Mr. Anand is a distinguished member of the Asia Pacific Financial Instrument Center of Excellence at Deloitte. Joining him today is Ms. Chandrika Sridhar, also a partner at Deloitte Haskins and Sells LLP. With 20 years of rich experience in the domain, Ms. Chandrika is a highly accomplished chartered accountant. She is located in Mumbai and brings valuable insights to our discussions today. Welcome both Mr. Anand and Ms. Chandrika, and we are honored to have such esteemed professionals with us to share their esteemed presence here today to share their expertise on this crucial topic. Small disclaimer I would like to make is that the views and opinions expressed today are speakers and do not necessarily, not necessarily represent the official stance of NFRA or the organization that the speakers represent. In the spirit of collaboration and shared learning, I encourage each one of the participants to actively engage with our panelists today. I once again extend my warmest welcome to all of you. I wish a fruitful and enriching experience in today's webinar. I now request our distinguished speakers to formally begin the presentation. Thank you.
Thank you. Thank you, sir. Good afternoon, everyone. And a big thank you to NFRA for providing us with this opportunity to share our thoughts and insights on the two very key topics. One is inventory and the other is receivables. And actually, we would think that it is extremely timely, given that we are entering into the month of March, with all our year-ends, which is just coming up now in the next 31 days. And these two topics are highly, extremely relevant and very, very timely. Over the next hour or so, Anand and I will walk you through the procedures to perform and document in relation to the existence assertion for inventory and trade receivables. We will be covering the assertion of only existence in the conversation today. We start with inventory. I will walk you through inventory, and Anand will walk you through receivables. And between the two of us, we'll try to address any questions that you might have as we go along. Anand, is it possible to put on your mute? I think there's some disturbance. Thanks, thanks. The next slide, sir. As we move on to the next slide, so just a very, very quick introduction, which means that all of us know that when we're looking at existence as an assertion, maintenance or understanding the types of the inventory systems that a company has to track and maintain inventory records is very, very critical. Generally, there are two types that entities would normally use. One's the perpetual inventory system, the other is the periodic inventory system. The perpetual inventory system, just to rejog memories, is fundamentally when an entity updates quantities on hand and they determine on a continuous basis. Generally, this is accomplished by connecting the inventory system with the purchases system and the order entry system in the case of a manufacturing entity, or with a point of sale system when it is in the retail space. A periodic one when something is updated on a periodic basis. This is something that we would generally see in smaller companies. And in such companies, we'd also see something like a consumption then becoming a balancing figure. Like we all know, inventory pretty much has along the entire landscape of where it sits. One of the key account balances that we have in the case of a manufacturing, in the case of a trading entity, and so on and so forth, one of the key account balances, there is a full accounting standard dedicated towards existence of inventories itself, which is our SA 501. Very, very important for us to understand the nature of the company's business, the types of the company's products, the breakdown within it, as in going absolutely double clicking into each of those, understanding the types of inventory within raw material, what sits within it, within work in progress, what sits within it, within finished goods, what sits within it. And if there is going to be more than one location, how is the entire inventory system being maintained? And what exactly is that which the management does from an inventory count standpoint? As auditors, we also know, this is again just to rejog memory. As auditors, we also have specific assertions that we are required to make in CARO. One, whether the physical verification has been conducted at reasonable intervals. That's one assertion that we need to make. Whether coverage of such physical verification is appropriate. Whether discrepancies of 10% or more in the aggregate for every class of inventory has been appropriately dealt with. The guidance note, which has been published by the Institute, pretty much gives in great detail in terms of what needs to be done. Aside from this, there are two more hits that we have insofar as CARO is concerned. The second hit that we have is from a perspective when a company is sanctioned, a working capital facility of 5 crores or more. In that situation, on the basis of security of current assets, the requirement of the auditor is to go back and see whether the quarterly returns are in agreement with the books of accounts. So that is one very specific assertion that needs to be made. And the last thing that we also look at from an inventory standpoint is linked directly to going concern. And that is something which is from a perspective of understanding the ratios and speaking about those, with companies also giving a disclosure for those. This is fundamentally the lay of the land. The second auditing standard that also has a direct interplay in terms of what we do for inventory. I'm not going to now talk about what we have, from a perspective of understanding business, of the risk assessment. Those are standards which address across the landscape. But the other account auditing standard that I'd like to talk about is the one on external confirmations. And that is something that we will speak about from an inventory standpoint very, very soon. Next slide, sir, please. If you can move on to the next slide, sir.
This is slide 3. Can you see it?
Not yet, but yes, of course. I'll start talking about it. I guess by then the slide will move. This is fundamentally, this slide basically addresses understanding what really can go wrong. So we've kind of broken this down into 3 elements. Not yet able to see the slide. So.
Yeah.
Okay, whilst the slide comes up, I'll start talking about this. Whatever we've put up on the slide is fundamentally illustrative in nature. There could be many, many more things that could go wrong from an inventory existence standpoint. The first one that we thought we'd cover was inventories recorded in books, not physically available, or the discrepancies between the book stock and the physical stock not been recorded. That'd be the first thing that could go wrong. The second one is inventories held on behalf of third parties, not appropriately segregated, and therefore inappropriately considered in the valuation of inventories. The third one is when inventories are located at third-party locations, not appropriately considered and therefore either included or excluded in the carrying value of inventories. I think now we're looking at a cross between 2 slides, but nonetheless, I'll proceed. Like we know, from a risk assessment standpoint, it could be a normal risk, it could be a significant risk as in the assertion of existence, or it could be a significant fraud risk. At which point in time one would place this is going to be dependent significantly on the nature of the industry. If the industry is, for example, significantly susceptible to a very, very high level of theft, for example, jewelry, one might probably want to park it at a higher level of the risk, which is either a significant or a significant fraud risk. A number of signals that one must watch for as part of the fact-based risk assessment that we do is understanding what are the links that this particular inventory could have to various other decisions that a company would make. A, is it a significant account balance in the balance sheet? Is the company trying to obtain any form of financing for this inventory? Has the inventories changed from period on to period? Is there something which is inconsistent sitting within the financial statements, which is, there could be a situation when the inventory is rising, but the shipping cost could be reducing. Are there significant adjustment entries that are being passed? One would assume that given that today we are in a world of interlinked world, and therefore interlinked connections between account balances, one would expect that any movement into inventory and a movement out of inventory is going to be completely automated. And then if you're going to have manual entries which are sitting there, then that is again something that needs to, that potentially a red flag that one must consider. Is a particular industry in a business which is, continuously having to have upgrades? So if there are going to be, for example, if you're looking at mobile phones, which is the old version of mobile phones, no point having those inventories on hand. So that doesn't really make sense. That's another factor that one needs to consider. The next thing is, so those slides have gone away. The next thing probably would be, is the inventory recording system, is that manual or is that automated? Has there been a significant write down of inventories over the past period? How does the inventory turnover ratio look like? Is that fluctuating significantly? There could be many, many more factors that one needs to consider. Each of these would change based on the type of the industry and the nature of the product that one is dealing with. But of course, it is very important to understand each of these before we determine in a risk assessment landscape what really can go wrong, because end of the day, inventory is one item within the financial statements where physical custody is going to be extremely important, similar to what we have in a cash situation. And this is something that could be highly susceptible to pilferage and therefore very critical for us as auditors to understand the lay of the land, to understand clearly the nature of the business, to understand clearly what are the products before we go on to start designing the various steps and procedures that we would perform. One of the important things that we also need to consider is from a perspective of understanding the controls that sit within the management. So the slide deck is, Anand, are you able to see the slides?
I'm able to see the slide, Chandrika. This is the next slide which has come through.
Okay, I'm not able to see the slide. If it's slide 4, which is
This is slide 4. Yeah, we are able to see slide 4.
okay. So I still unable to see the slide. So fine. So if you're on slide 4, fantastic. On slide 4, which is basically understanding the design of the entities count program. All of us understand that for purposes of existence, inventory verification is pretty much the only control that a company could have. And that is pretty much the key control that resides within the company. And as auditors, given that for most of the engagements, we have reporting on internal financial controls over financial reporting, this is going to be an account balance. And certainly this is going to be an assertion that we would scope in as part of our testing activities. So therefore, it's extremely important to understand the design of the count program of the company. Before we get into the details, the first fundamental foremost thing is I'm going to take an example out here. I'm going to take an example of a retail industry. Slide 4, I think we'll stay on slide 4. I think somebody has messaged that they can see slide 5. We'll stay on slide 4. Taking retail as an example, in the retail industry, generally for a particular product, you would have the warehouse and you would also have the stores. The type of the controls that could reside within the warehouse would be fundamentally different from the types of controls that would reside within the stores. This would be very important for us to understand because the type of the controls within the warehouse and within the stores would be designed very differently by the company. And for us to labor on top of that and understand what are the controls testing that we need to do and what's going to be the nature, timing, and extent of procedures that we will do from a controls testing and from a substantive testing perspective becomes very, very important to understand the design. And it is very clear that a control that is there for a raw material is going to be fundamentally different from a control which would be there for WIP or for FG. It's going to be different for each. And the control that the company will exercise for stocks that are residing in third-party locations are also going to be different. So there is not going to be a one-size-fits-all. There has to be a significant level of disaggregation. And this completely sits squarely as part of the requirements of CARO as well when we go on to look at discrepancies out here. What are the various things that one needs to consider? The first thing is, what is the nature of the count procedures? Who exactly would perform the count? There is no point having the storekeeper who's going to perform the count as well, because then we've broken the segregation of duties out there. What is the frequency? Probably in a warehouse, the control, the design of the control could be that maybe a quarterly control. It could be once in 2 months control. It could be a monthly control. Whereas in a stores, the frequency of the control could potentially be, depending on the type of the particular product, that could maybe a monthly control. If the company has broken down its products within its stores into maybe A, B, and C categories of types of stores, it could be that for an A kind of a category, the frequency of controls could be very different from what you would have for a B or what you would have for a C. It is therefore very important for us to understand insofar as what is the control that is residing within each of this. How is the design of the control out there? Is the design end of the day fit for purpose? Is it going to meet the goals insofar as understanding if the controls have been designed properly? And similarly for investigating differences. Next slide, please. Once we've understood the design of the particular control that the company has in relation to each of the types, for warehouse, for stores, within the stores for each of the various types A, B, or C category, out there, it's also important for us to understand how is the management even evaluating or determining what should be A, what should be B, what should be C. The management, as part of their controls, would be actually looking at all of this. What, supposing they're going to say that those products which is sitting within, or a depot or a pharmacy sitting as part of A, identified as category A, are they going to be doing a 100% physical verification, or are they going to be looking at some other kind of sampling over on top of that? How is that sample determined? What's the kind of documentation that the company is maintaining for all of this? This is very important for us to understand before we go on to test the design. And testing of the design is going to be possible generally only if we are physically out there when the company is exercising the control. Like we all know, for purposes of controls testing, you have your inspection of documents, you have inquiry, you have observation, and for an operating effectiveness, we also have something called a reperformance. So when you're looking at the design evaluation, if the design has been properly laid out, it's very important for us to have been sitting there and observing this happening. It doesn't mean we need to be sitting at all, but that observation will have to be there. We have to be physically there, and that will have to be clearly evidenced in a working paper file. The next thing is from a perspective of the testing for the internal controls. All of us know that internal controls testing is pretty much attribute testing. Attribute testing prior to the physical verification, attributes testing during the physical verification, and attributes testing after the physical verification. So this is pretty much entirely what we do as part of our operating effectiveness testing. Here is something that we're going to be looking at what the company has done, testing the controls that are existing within the company, because this is something that's going to help us give an assertion in Caro as well as provide an assertion insofar as the internal financial controls are concerned. I'll just pause here. I think, Anand, there are some people messaging saying that they're not able to hear me clearly. I just wanted to check if you're able to hear. Or Sham sir, am I audible?
No, we are able to hear you clearly, Chandrika. So maybe some bandwidth issues at some locations, but we are able to hear you clearly.
All right, thanks. Thank you, Anand. So as we go on to do our controls testing, the attributes that we need to test for each of the samples that we select. For each of the samples that we select, the attributes that need to be tested would be adequacy of the instruction, whether the instructions are fit for purpose, whether the person who is going to be doing the inventory count, whether that person is capable and competent of doing the inventory count. The next thing is whether the instructions are coherent and detailed enough for the person to understand what that person is expected to see. Then, whether the instructions have been clearly signed, whether the count sheets have been tagged properly, whether they've been pre-numbered properly. Like I said previously, this is one area which is clearly susceptible to fraud, and therefore numbering, pre-numbering becomes extremely critical. Then at the point in time during the physical verification, because oftentimes what happens is one of the tests that we could do as part of our controls testing is reperformance. Reperformance means using the same samples that a company has used for purposes of understanding if the control has actually operated effectively, which means we need to be present in all of the locations at the same point in time, which may not be always possible. Therefore, reperformance is one thing. If we're there, it'd be perfect. Otherwise, you would probably generally be looking at inspecting underlying documents. And when you're looking at inspecting the underlying documents, it's important because we're testing for attributes, controls testing being an attributes testing, evaluating all of this, the attributes before the count, the attributes during the count, whether the book versus the physical discrepancies have been clearly identified, whether they've been clearly compiled, and then there's been actually responsibilities taken and signed by the people responsible for this particular control owner. That entirely those signatures will have to be also in place. Has the damaged, slow-moving, obsolete stocks have been clearly identified? Here, I would also bring in some industries. You have, for example, auto. You would have something called a concept of bill and hold. And that is something which is very, very critical when you're looking at a cutoff assertion, which kind of end of the day links in back to your existence as well. If, as part of understanding of the business, if that particular business operates in the position when they could have significant bill and hold, this is one thing that will have to trigger a red flag in our minds, because then that is going to be very important as a connecting the dots insofar as what's sitting within inventory. If bill and hold is something that the company usually does, then are those materials segregated? I'm not looking at the revenue recognition here. That's another concept completely. But is it completely segregated and kept and not included as part of the inventory? Because if it wasn't, it would be a double count. The next thing is attributes testing after the physical verification is done, which means that all of those activities that happen post, which end of the day goes up to recording of that inventory. End of the day, whatever is the final count is something that needs to be residing in the books as well. That entire piece, for every sample that we select, whatever you see on the slide is something that needs to be clearly evidenced and documented. How would the sample be determined? The sample is going to be determined on the basis of the frequency, and then your nature, timing, and extent of the procedures that we would perform will entirely be dependent on our understanding of the business and the nature of the frequency and the type of the controls that reside within the company. End of the day, it would mean that your the frequency, whilst you have the frequency, it could be a monthly control, it could be a quarterly control, it could be a half yearly control. One of the things that I would like to say, when something, let's assume it's a retail industry and the company has a control of physically verifying the quantities only once in a year. Here it means that the design itself is not appropriate. The design itself has failed. So therefore, here is a direct interface that you would take it back to your IFCO for reporting. As you go on in this, insofar as navigating through this process, there could be a number of control deficiencies that might crop up. And then your SA 265, which is communicating control deficiencies to management and those charged with governance, will kick in. Inventory physical verification is one thing that can never be done later. It has to be done. If it's done today, it has to be done now, closed now. Everybody involved, including the controls owner and the reviewer, will necessarily need to sign off, because that is something, except if somebody is going to recount the whole thing later on a later date. That's a different storyline. But end of the day, if it is very important for us to understand if the design is fit for purpose. Whether the design is fit for purpose or not is something that can be understood only if we clearly understand the company and the nature of the product. Next slide, please. We'll go on to substantive testing. So we looked at controls testing now. On the substantive side of things, the substantive testing is the testing for the samples that we select. You'd have an SA 501, which talks about situations when basically the standard says it's absolutely mandatory for us to, as auditors, to attend the physical verification that the company does. That's an absolute mandatory standpoint. And the standard goes on to say what happens otherwise as special considerations, which I will actually delve upon in the next slide. You just stay on the previous slide, please. Substantive procedures. Yeah, thank you. Substantive procedures is pretty much what we do, which is the MUS or any other sampling methodology that we apply. What is the population on which the sampling methodology will apply is going to be fundamentally driven by the concepts that we previously dealt with. It's again through the eyes of the management. It's going to be disaggregated population of raw material, WIP, FG, third-party locations, goods in transit, etc. Within raw materials, we're going to have a very, very disconnected kinds of products. Each of those would be a disaggregated population. All of that will drive the number of samples that we select. And for each of the samples that we select, which is going to be we are required to be, when we're going there for a physical verification, that is something that we will select as part of our testing. And what you see on this slide is entirely what is required to be done with respect to the samples that we select. It could be flow to sheet, sheet to flow, depending on what we're looking at out there. Documenting clearly in terms of the count that we've performed for all the samples. In order to ensure that we have achieved full coverage, touring the entire location to make sure that something is not sitting in a cozy corner that we're not looking at, something is not sitting tucked away and not shown to us, because this is an area which is clearly susceptible to fraud. Scrutinizing clearly how this entire count is being done. After every time you've covered an area, marking those in such a way that this is a particular area that we have counted, and closing off that. That could be situations when we also need to include specialists. When we're going to be involving either the auditor specialists, that is something that we'll have to also clearly evidence insofar as why was it specialist even relevant. For example, important to understand the unit of measurement. Supposing we're looking at coal, I'm giving an example of coal. That's something that is not going to be possible for us to count. It's not like 1, 2, 3, 4. That's going to be based on the volumetric measurement, and that is going to be based on the space that the coal dump occupies. So for this, we probably need a specialist to help us get to the answer we need to get to. So that is something that has to also be clearly evidenced in our files. As part of the entire testing that we do, clear identification of the slow moving stocks. Cutoff out here is very important. Goods that are physically received, not yet recorded. That could be a situation. But goods which have been invoiced but not yet dispatched, that's clearly kept in a separate location, should be moved out of inventory. Bill and hold can potentially come here also. And end of the day, as part of completing all of these procedures that we do for substantive testing, obtaining copies of all the count sheets and retaining all of that as part of our evidences is very, very important, because this is going to be the fundamental evidence that we are going to be using, and it's going to be a feeder into the valuation work paper, wherein we're going to be tracing all of these quantities into our valuation work paper. And that is something which is finally going to sit as part of that key number that sits in the financial statements. This is one number which can significantly influence the profits of a company. Therefore, inventory is actually one of the sole numbers. And this is something, given that inventory, this is a particular account balance which impacts sales, impacts purchases, impacts consumption. So this is going to be the front and center of every financial statement that we're seeing. So therefore, reason why there is a specific standard which deals with the mandatory attendance at a physical count. Next slide, please. On specific considerations, there could be situations when the inventory is not being, a verification is not being conducted by the management. This is a clear situation of how your SA 501 will be invoked, fundamentally understanding why. Was it impractical? It goes to the next position, which is, was it impracticable? Impracticable is something only expected to be extremely rare, the rarest of the rare situations. This was something that we had invoked during the COVID times, when sometimes it was impossible to actually visit a location. There could be very many ways of actually conducting a physical verification. Sometimes you could even use drones. For example, if you're looking at a far off location which cannot be visited for whatever reason, for defense reasons or whatever, and you have a salt pan out there, could actually have the facility of a drone go out there, man mark clearly what is the particular area, use volumetric measurement to determine or estimate what should be the value, what should be the what should be the inventory which should reside in the books. In the case of inventories held by third parties, this is a very, very important consideration point. Who is the third party? Is the third party a related party? Because if the third party is a related party, the antenna will actually go up in order to understand if somebody is actually helping the client manage the inventory piece. Because this is something, like I said, has a significant impact on earnings management, profit management. Your EPS gets impacted, and your ratios, your going concern, it has a spiraling effect over a number of account balances. Obtaining direct confirmations, one is, yes, it's good. Anand is going to be talking more of confirmations. What he says for debtors would equally apply for inventory as well. Very important for us to understand and read, because if a third party is going to be managing the inventory, simply relying just on the third party for a count that they would perform is not going to be sufficient. The management has to have a way. The management, as part of its controls, will also need to physically verify on a periodic basis the location of the third party to understand if it's all okay or not. As part of the testing that we do, in order to, this is specific test honing in, if you believe that there is a significant fraud risk as well sitting out there, depending on the nature of the industry and the product and our experiences, it could be that we also need to see, is that particular go down, I would see it at all points in time with a particular go down, or is that this is equally applicable even for a situation, not just when a third party is used for storing the particular item. Why a third party is the first question. Secondly, is that particular area even capable of holding the inventory that is being shown in the financial statements as residing with a third party or in a particular go down? Is it even capable? Is that area even reasonable for one to understand and expect this amount of inventory to be sitting there? These are some things that be very, very important to understand when third parties are involved. More so when it's going to be inventory in transit. Let's assume inventory in transit. It's very critical to understand the logistical logistics into so far as how far is the other place from where inventory is going to be coming in. Is that place 2 days away? In which case, I cannot have something in goods in transit sitting for more than 2 days. If there is some inventory which is being purchased from abroad, let's assume it takes 1 month for it to come. I cannot have something. I'm assuming here that the title has passed, therefore we're setting up the GIT. You cannot have something which is going to be sitting there for more than a month. Certainly, you cannot have something sitting in GIT for the longest period of time, because that means that there is something which does not seem to be appropriate. In the same breath, if you're finding situations when there are very, very significantly high provisions that are being made or write-offs that are being made, the question to ask is, did those inventories even exist in the first place? So these are the things that we need to be very, very careful, worry about as we go on to test inventory, because this is one thing that has a spiraling effect across very many account balances. What we have laid before you is, over the next few slides, I think these slides will be put up for your reference as well, insofar as what could be some kind of checklist that we could use as part of our procedures, that as part of what questions that we must ask. Next slide, please. During pre-count, during the count, post the count, and documentation of floor to sheet and sheet to floor, and where there are discrepancies, how to document those, how to make an evaluation in terms of nature and cause of those misstatements and discrepancies, because there is one area which we're not covering now, because that's going to be a much larger discussion in terms of extrapolation of potential misstatements if there are discrepancies. So we will leave these behind with you for you to use as part, for you to consider and use if you deem it fit, as some kind of inputs on potential methods under which documentations can be made. This is something that we had from inventory. I will hand this over to Anand. Anand, if you want to add on anything on inventory, and then take it up for others, please.
Thank you, Chandrika. I don't have anything to.
Yeah, we can't hear you, Mr. Anand. We can't hear you. Kindly unmute yourself. Mr. Anand, am I audible? We can't hear you. Yeah, now, yeah. Please go ahead.
I'm not able to see the slides, sir.
Yeah.
So if you go to the subsequent slide.
Yeah. Can you see the next one?
A part of the placeholder is visible, sir. Do you want me? Do I try to put up the slides? Yeah, it's visible. No,
it's visible, right?
No, the first slide is not visible, sir, at this point in time.
Okay.
The slide which is immediately after the placeholder.
Okay.
Should I try putting up the slides?
Please try it out. Yeah.
Thank you, sir. Are you able to see the slides, sir?
Yeah, we can see it. We can see it. Yeah.
Okay. Apologies for the technical glitch. So moving on to receivables, as Chandrika said, we would be again covering the existence relating to accounts receivable. And if we sort of focus on the existence of accounts receivable, in industries such as technology, in industries such as manufacturing, in industries such as construction industries, the receivable or the unbilled balances is significantly high, right? If I look into industries such as retail or industries such as telecom, the receivable balances are relatively lower because a lot of these balances, as far as retail or telecom is concerned, is either based on a cash basis of business or based on, let's assume, electronic payments businesses, or it could be prepaid businesses in telecom. But if you look into an automotive industry, if you look into a technology industry, if you look into a construction industry, the receivable is a significant account balance in the financial statements, right? And therefore, the existence of receivable is of paramount importance, given that the direct linkage of that receivable to revenue, which, from our accounting standards perspective and even from an auditing standards perspective, is a significant fraud risk. There's a presumption of a fraud risk as far as revenue recognition transactions are concerned, which the auditors would need to evaluate and identify what that fraud risk relates to. And therefore, the secondary aspect of that is the existence relating to that particular transaction, right? Now, if I look into in terms of which are the most relevant aspects which I should consider when I am doing the risk assessment, right? What I should then do is I should start comparing what is the total amount of receivables in the balance sheet and what is the materiality which the auditor or the company is determined. If let's assume the materiality is 100 crores and my receivables is 1,000 crores, right? It is 10 times of materiality, right? If my materiality is 100 crores and my receivables is 2,000 crores, it is 20 times of materiality. And therefore, anything which can go wrong if a balance is so high compared to your materiality means it requires more attention from an audit perspective. The second is, right, what is a data sales turnover ratio, right? For example, if I have a aged data, or for example, my DSO days is significant, right? In certain of the industries, the DSO days could range from 180 to 365 days. In certain of the industries, the DSO days could range between 30 to 60 days, right? So it really depends upon which industry you're looking at, what is a turnover as far as the data sales turnover ratio is concerned for you to then evaluate. Then the question really is, what is a customer profile? Are there changes in customer profile? Right? Are there any unusual activities at or near the period end? Right? Each quarter from a listed entity perspective is something which you should be looking at from a risk assessment perspective to determine, are there any topside adjustment entries which is being recorded to data and therefore to sales, right? Are there any unusual relationship between data and sales, right? Then are there any aged receivables which you have, right? Is the data there in multiple geographies? For example, let's assume a company has got a business in Nigeria where you're not able to extract money. Or let's assume a company has got a business in Myanmar, right, where there are exchange control restrictions. Or let's assume a company is operating in an industry where there is hyperinflation, for example, Argentina or Turkey, right? Then those are potentially red flags which you should be considering in terms of whether those data will need to be evaluated separately, not only from an existence perspective, but also from a valuation perspective for the purposes of provision for loan losses. Is there a history of high credit notes which is being provided, right? Again, that is something which is really important. The more number of credit notes which is provided, the higher the value of credit notes which is provided, then there is an issue as far as basically, whether what has been invoiced, I can collect or not collect, right? Is there a change in the policy in terms of any revenue recognition? So these are all external factors which the audit team would need to evaluate, right? There are certain internal factors. For example, is there a significant system change which has happened during the current period, right? Has there been a lot of attrition as far as the people who are managing the entire receivable invoicing process or the collection process, right? Is there more manual entries which is recorded compared to automated entries, right? The more manual entries would mean that, again, there are issues in terms of, whether the recording of invoice to the correct customer account and the collection of that invoice and then application of that collection to the correct customer account, whether that will be appropriate or not, right? Is the IT system very complex or is the IT system basically simple, right? Are there multiple components having different IT systems? Which means that, again, your testing then would be based on how those those IT environments are designed, right? Then are there any top-sided adjustment entries which have been recorded to the receivables, right? Have there been deficiencies which you have noted in the prior audit, right? Are there any changes in processes and controls which has been instituted in the current period, right? Are there any changes to the contract or the agreements? Is the agreement standard with the customers? Is the agreement not standard with the customers, right? Are there related party transactions which are potentially high? So what we have put out over here are potentially questions which the audit team should be answering in terms of determining where the risk lies, right? If I look into a thermometer or a barometer, the higher ASS would mean that the receivable existence related relevant assertion from an inherent risk perspective is higher. And therefore, the nature, timing, and extent of the procedures which I would need to perform as an auditor would also then be higher to that extent, right? So these are things which would need to be evaluated. These are things which needs to be done at an interim, but these are things which needs to be updated for the year end, right? Your risk assessment is an iterative process, and therefore, whatever you do during an interim stage would then need to be updated so that the conditions which exist at the interim is rolled forward to what you have at the year end. Sir, if I go to the next slide, please. Sir, we're not able to see the next slide.
It is your screen that we are viewing.
Oh, I'm so sorry. I'm so sorry.
Yeah, you have, yeah. Yes,
sorry.
We can see the next slide. Yes.
Thank you.
Yeah.
So once we determine what the risk assessment is, right, the next aspect of what we need to do is to test the controls, right? For all the entities, the listed entities and the private listed entities, the IFCOFR is mandatory. And therefore, as auditors and as management, right, the management is testifying on internal controls. They are giving an opinion. And the auditors are also giving an opinion on internal controls, right? And therefore, what typically we see as controls relating to existence of accounts receivable are 3 or 4 things. The first one is the controls around the customer master, which means that at what point in time a customer gets recorded in my SAP system or in my IT system, what are the controls around how the customer master gets updated, who's got access to the customer master, who updates changes to the customer master. And if you would see, this control is something which we test as part of not only the accounts receivable existence, but also in part of our entire accounts, the entire revenue recognition process. So the first step in the entire revenue recognition process itself is a creation of the customer master, and therefore that control would need to be tested, right? The second control which we need to test is the recording of the sales and the related accounts receivable itself, which means that who creates the purchase order, right? Let's assume in a manufacturing organization, who creates and updates the price master? What are the controls around the price master, right? What are the controls which includes both the manual and the automated controls around the recording of the GRN and therefore the pick slip and therefore again the sales and ultimately the recording of the invoice and the dispatch of the invoice and the receipt to the customer. So these are all the controls which you would test as part of accounts receivable, as part of your revenue recognition process, which will also help you to satisfy the assertion relating to accounts receivable from a controls perspective. The third part of the control is really the collection control. And what I mean by a collection control is that, who receives the money, right? Which is the bank reconciliation control. Then how that money is applied to the particular customer. It should not be a random application, right? It should be against a particular invoice for which the money is being received. For example, if let's assume the money is, sort of applied on a FIFO basis, that's a red flag, right? Let's assume if the money is applied on a LIFO basis, that means there is a red flag. If there are unapplied collection, which is there in a, suspense account, again, that's a red flag, right? So there needs to be a continuous process, and there are continuous processes in a lot of companies which we have audited, where this happens on a weekly basis and even on a daily basis, right? And ultimately, the final control is where on a periodic basis, right, the company sends balance confirmation to the debtors or to the accounts receivable, right? They receive the statement of accounts as far as these accounts receivables are concerned, and they are then all reconciled back to what is there in the receivable balances, right? So these are the four bouquet of controls which you as auditors should be testing. And it is an expectation that in an audit where there is an IFCO file which is involved, the control becomes of paramount importance, right? If I go then from the controls into the substantive procedures which needs to be performed, SA 505 actually talks about two types of confirmations which the auditors would need to roll out. The first is called as a positive confirmations. The second is called a negative confirmation. And I will focus my predominant amount of energy on positive confirmations, right? Given that negative confirmations should not be used and should be used in very, very limited circumstances. I'll come to that in some time from now. But if I focus on positive confirmations, right, there are two types of confirmations which SA 505 envisages, right? The first is what is called as an open confirmation, and the second is what is called as a closed confirmation, right? What is an open and what is a closed? For example, let's assume that company A has got a balance which is outstanding from Facebook, and it sends out a balance confirmation to Facebook and says that, you know, Facebook, you owe us 200 crores, right? Now that's a closed confirmation, which means that you are essentially putting a balance on the confirmation request and saying it's a closed confirmation, right? And therefore the auditor would prepare a confirmation request which would be signed by the authorized signatory of the company, right? Wherein it would essentially state that you, Facebook, owe us 200 crores, right? Now, the other way of doing that is to again send a confirmation to Facebook, but leave the balance blank, right? And that is called as an open confirmation. The open confirmation actually satisfies two assertions. One is the existence, and second is the completeness assertion relevant to an accounts receivable balance. And therefore, generally, the open confirmations are more persuasive. So for example, if you send a confirmation to a bank, you would generally want to send an open confirmation because you not only get a confirmation of what are the bank accounts which are there in the GL, but if there are any bank accounts which are not there in the GL, that also gets confirmed to that extent by the bank, right? So the same way the accounts receivable process also works, and therefore the open confirmations are more persuasive and gives us a higher level of assurance. And therefore, the engagement teams, the audit team should be following up on an open confirmation process or a closed confirmation process. Now, if I go to a negative confirmation is where you send out a confirmation, right? But basically, stating that, this is the balance you owe to us. But if I don't hear back within a specific period of time, I would deem that balance to be confirmed, right? In this today's age and world, right, negative confirmations are something which we have not seen as an audit profession for a significant amount of time, right? But from a standard SA 505 perspective, a negative confirmation can be rolled out when the account balance is low risk, right? The controls are operating effectively. It's a homogeneous population. For example, in a technology company, each revenue contract is different, and therefore you'll never be able to roll out a negative confirmation, right? For example, in construction industry, each contract is different, and therefore you'll never be able to roll out a negative confirmation, right? The balance itself is very small, and the most important thing is you expect to receive a reply back, right? If any of these conditions are not satisfied, right, the negative confirmations goes out of the window, and therefore you also need to resort to a positive confirmation request, right? Now, from an auditing standard perspective, the first step is to roll out a positive confirmation request, right? The second step, if you've not received a reply, is to follow up on the positive confirmation request, right? The third step is to do a second follow-up on the positive confirmation request, and assuming that you have done sufficient follow-up and not got the replies, that is when you go to an alternate procedure domain, right? And I'll talk about it in some time from now, right? Now, when you design your confirmation request, what you would really need to do is you would need to design the confirmation request under your control, which means you as the auditor would need to design the confirmation request under your control. At no stretch, that confirmation should be designed and done by the client, right? And therefore, from that particular perspective, right, the completeness of the account balance should be something which the engagement team should ensure, right? An appropriate population is considered for the purposes of selection of testing. What that means is that when I send out a confirmation request, the entire account balance relating to the accounts receivable would need to be selected, right? Irrespective of which location it pertains to, right? You should select balances with large account balance or customers with large account balance, but that doesn't mean that the rest of the population is not selected for the purposes of testing. You can select customers with large account balances, but the remainder of the population should be subject to a sampling under the sampling guidance of SA, right? Then the third thing is that management should be performing an authorization of that request, right? Once a sample is being selected, based on management's insistence, right, you should not be changing the sample. For example, the management may come back and say that, look, I don't expect a response from this particular customer, and therefore, please go ahead and change the sample. I will not sign the confirmation request, right? Now, that potentially is a limitation in scope because that is a statistical sampling which you have derived. And from that particular perspective, right, you have all the rights in terms of determining to which customer you would need to send a sample and why you need to send that sample, right? Now, once that has been decided, the next step in the entire process is to ensure that the confirmation request or the letter, right, asking or authorizing the auditor to send the confirmation directly to the customer should be signed by somebody who's authorized in the company. And then you would need to go back and vet that with who's authorized to do that, right? Through the authorization matrix, which has been defined as per the policies and procedures of the company, and ensure that the person who is authorized is required to sign that letter, right? Then the next step in the entire process is to ensure that the email address of the customer is appropriate, the email ID of that customer is appropriate, the address is appropriate, the email ID is not a fictitious ID, right? The email ID is something which can be reconciled back to the customer master, for example, right? Because you have tested the customer master and the access around the customer master and the changes to the customer master, it would be important for you to go back and check that, right? Then roll out the confirmation under your request, mail them under your request, receive them under your control, right? Then determine in terms of whether you should be profiling the population of the accounts receivable into accounts with larger account balance, as I said, old outstanding balances. Why are these old outstanding? Are they provided for, not provided for? Is there a history of, basically raising the invoice and then providing for it? Does it mean that there's a fraud element associated with this, right? Are there large balances with credit balances, right? Then accounts where provisions has been recorded, accounts with nil balances, right? The entire set of population should be subject to your sampling. And if it is not, there should be a valid reason which you should be documenting, right? The second step in the entire process is the receipt of the confirmation, right? And the receipt of the confirmation can be in two forms. One, you have received it through letter into your office, right? And opened under your control. The letter generally should be addressed to the partner or the senior most in the entire audit engagement, so that there is no chance of an interception. You should ensure that the entire letter, the posting of the letter, the receipt of the letter is all under your control. There is no chance of that to be intercepted by anybody else. Once you open the confirmation, ensure that the confirmation is received from the valid authorized signatory of that particular customer. And this is possible by going and checking into the email correspondences with that particular customer, for that particular customer, between the business relationship manager of the company and that relationship and that customer, right? You can also go back and check the logos and so on and so forth. And if you receive through an electronic medium, which was very, very prevalent and continues to be the most common form of receiving confirmations post-COVID, is the electronic medium, right? And again, there are chances of that being intercepted. And therefore, what generally you would do is to do a callback procedure, right? You would go back, call the person who is the authorized signatory of the customer who sent the confirmation, right? You would ensure that what is his designation. You would go back and check the previous correspondences with that particular person. You would go back to the customer master to check whether he's an authorized signatory to send the customer confirmations, etc., so that has been tested. You would go back and check the email ID and the domain name from where the customer is essentially belonging to. And there are various websites which are available wherein you can go and check the domain IDs and document that as part of your entire testing process, right? So it's very comprehensive. There's a significant amount of focus on receivables and inventory. Both receivables and inventory are liquid assets. The receivables and inventory are current assets. These are part of essentially the company's working capital management process. And therefore, from an effort perspective, the auditor's effort as far as these account balances are concerned is significantly high, apart from what you contribute and what you do for your revenue processes, right? So, this is again an illustrative example of how a customer process or a confirmation is designed. So in this particular case, you would send to the customer the balances relating to trade receivables, retention receivables, advance from customers, right? You would go back and check the signatory to the confirmation. You would go back and check the designation, name of the company, seal, ensure that that is appropriate, validate the authenticity of that, right? And then once you receive the confirmation, right, then you start evaluating what are the reconciling items to that confirmation. For example, revenue recognized at the end of the period are not accounted by the customer, right? You have sent the goods, he's not essentially received it, you have recognized revenue. Is there a revenue recognition cutoff issue over here, right? The payments have been dispatched and the payments are in transit, and therefore the customer is showing a lower balance, you are showing a higher balance, right? Right? Amount received is less than the outstanding invoice, potentially a dispute, potentially a part payment, potentially a potential credit note, right? Invoice is not confirmed by customer due to dispute. So all kinds of permutation combinations could potentially come out. And remember that you're doing a sampling. And therefore, if there are unreconciled balances, those unreconciled balances then would mean that, there is an error, right? That error then would need to be evaluated for two things. One, the extrapolation of that error to the entire population because you've done a sampling, right? And then determine qualitatively and quantitatively in terms of whether the error is material and whether there are indications that potentially other account balances are affected or potentially there is a fraud, right? So these are things which the engagement team should be careful about when they are evaluating receivables, right? If we go to the alternate procedures, in a majority of the cases, right, if the confirmation request is designed appropriately, you should be getting the confirmation responses. But unlike a bank account, the replies to a confirmation potentially are lower than what you would receive for banks as far as receivables is concerned. In certain industries, the response to the confirmation request could be higher. In certain industries, the response to the confirmation request could be lower, right? And what that would then mean is you need to go back and check it, right, against the subsequent collections. Again, this is an example. When I say subsequent collections, you need to go back to, let's assume, a customer. And let's assume a customer has got 10 invoices outstanding. You would then need to go back and check the subsequent collection for 10 invoices. You can't do a sampling over here, right? The second thing is, when you're checking your subsequent collections, right, you need to go back to the bank statement from where the money is received, and then link it back from that bank statement where the money is received to the invoice for which it has been received. For example, the customer may pay for 5 invoices together, and therefore the application then would need to be seen for 5 invoices, right? Now, going and checking bank book for that is an inappropriate audit procedure, right? And therefore, if you're doing substantive testing, your substantive testing is always reconciled back to an external evidence and not to an internal evidence, unlike an internal control, right? So the first step in that entire process is subsequent receipts, right? The second step in the entire process is, in certain cases, the collection may not be received fully. For example, things which have been invoiced closer to the period end. Or let's assume where the normal credit period itself is 90 days, or the normal credit period itself is 120 days. And what do you do, right? The next step in the entire process then is for invoices which are not collected, right? You go back and test the same way as you would go and test a revenue transaction, which means that you would go back and check the occurrence of the transaction, which means the goods received note, which is essentially acknowledged by the customer, right? And in this cases, now there are GST portals which are available. There are, truck details which are available, transport details which are available. And then the next step in the entire process is for that same invoice, you would also need to go back and check whether the rate is valid, and the rate is tied back to the contract with the customer, right? Which means technically you're going back into the revenue testing over here and checking and ticking and tying the outstanding invoices the same way as you would go and check a revenue transaction for both accuracy and occurrence, right? So if I go subsequently, right, these are some examples of good documentation and bad documentation in terms of what you would need to do. The information which is used for the purposes of essentially documenting your collections, right? The differences for that particular data for which the confirmation has been sent and what that difference pertains to, right? And then the alternate procedures performed, right? Now, I'm leaving this with you, but, I would say that if the documentation is sketchy, if the documentation is limited, right? You as auditors, even when you review it, right, you would not be in a position to understand in terms of what the engagement teams have done or what the juniors in the engagement team have done in terms of ticking and tying that appropriately to external evidences, right? And the more you document, the better it is, because that gives a clear evidence in terms of how things have been documented, right? Now, this is again another example of a callback procedure, right? Generally, when you do a callback procedure, right, there should be at least 2 members of the engagement team which should be present. The person who is calling and the person who is taking down notes, right, as far as things are concerned, right? And then again, example of, how you document the callback procedure. And this callback procedure, mind you, would need to be done for each confirmation which you are sending, right? The same way, the callback procedures would also need to be done for the bank confirmations which you are sending. Although bank confirmations is not part of the current day topic, right? But the confirmation procedures which I am talking about, SA 505, equally applies to banks. And therefore, the same callback procedures then will need to be done for that as well, especially when you are receiving, confirmations through an electronic mode, right? And the last one is roll forward procedures. Generally, given the timing at which clients or companies publish their annual financial statements, right? You would generally do a interim testing of your trade receivables. And what that means is that instead of sending confirmations on 31st of March, you would send confirmations on 28th of February or 29th of February. And then what you do is, once you send out confirmations and reconcile all the confirmations which is received and perform all the alternate procedures, you would then basically roll the entire balance forward to 31st of March. And what that means is you would take the balance, assuming that everything reconciles back as on 28th of February. You would add the sales for the period. You would reduce the collections for the period. This is a very simple reconciliation, but that could be potentially Forex. That could potentially be allowance for loan losses. That could be credit notes which is issued. That could be discounts which could be given, and so on and so forth. And all of that then would need to be reconciled. And then the more important thing is, right, out of each of the reconciliation items, again, the engagement teams would need to select samples to ensure that from the interim date to the roll forward date, the testing which you are done, right, reconciles back to the auditing standards, right? So this again is something which is really, really important. Sometimes the engagement teams roll forward the same confirmation from 20th of February to 31st of March. But given that you have done a sampling, you have done all the reconciliations relating to that sampling, right? And therefore, you have got the assurance which is required for 28th of February. The entire account balance needs to be then rolled forward rather than rolling forward that same confirmation, right? So with that, I end the presentation. I'll stop sharing the presentation at this point in time. And if there are any questions, I and Chandrika would be more than happy to answer, sir.
I can just add on a couple of points, Anand, just a couple of them. So one thing is, whilst Anand did speak about confirmations, one thing that we might want to additionally bear in mind is from a perspective of related parties. If the customer is a related party, then there is much more that one needs to do. And if it's going to be a significant related party transaction, then there are other angles and elements that one needs to see. A mere confirmation may not be enough in such a situation. Therefore, that is another point that one probably would need to bear in mind. Similarly, if there are extensive provisions or write-offs, that is another angle, that is another red flag that one needs to see without, sending a legal notice and then going ahead and making a provision. So that's another point that just leave behind with you from an existing standpoint. And the last thing is, whilst Anand did touch upon it, the more external the evidences are, the more persuasive they would be. And therefore, in today's world, there is enough and more that we can use technology and a number of websites which actually provide information that we would be in a position to use for purposes of doing some kind of a sanity check on what we are getting from inside the company. So external parties who are weighing a particular product, external parties who are completely not related parties. So each of those external evidences that sit out there, eparivahan.com actually tells you whether the registration number of a particular vehicle, whether the registration number actually belongs to that type of vehicle and whether that vehicle is capable of transporting a particular good. So you have all of these things which is today available for us. And struck-off companies is another disclosure that a company will need to make as part of financial statements. Connecting these dots along the way as we go on, each of these are not separate silos. One will need to take a look at all of this together and connect the dots to understand, are we trampling on a 143.12? So these are some things that just thought that add on to what Anand just said. Nothing else further from me.
Well, that was wonderful. And considering the intricate nature of the inventory systems and the potential for discrepancies, I think you took us through a wonderful presentation. And we apologize for some technical glitches that cropped up. Right, we are very sorry for that. There is one question which a participant wants to know as to confirmation for government data. Yeah, how do you obtain confirmation from?
Let me take that, sir. We have seen this in multiple places in terms of government data. Now, if I go through the revenue recognition process, right, In a majority of the cases, the invoices which is outstanding, prior to the acceptance of the invoice itself, there would be, acceptance of that particular invoice from the government departments, right? There is an explicit acceptance by the government department. It goes through various levels of approval. One at a time when the goods are delivered, one at a time when the services are accepted, and second at a time when, let's assume, the money is going to get received as well, right? Now, potentially, the response rate for confirmation from government could be lower compared to, let's assume, for a private customer. But that doesn't mean that I'll not be able to send confirmations to government. The question then really is that should I be performing alternate procedures in the expectation that the response rate is poor, and ensure that the alternate procedures are performed timely, given that, in certain of the industries, the government data could be significantly higher. In certain of the industries, that could be reconciliation issues which needs to be sort of sorted out, and therefore all those reconciliation issues could come to the fore. And therefore, again, going back into what I discussed on controls, right? Generally, there is also a statement of account which is exchanged in the government. Generally, there are payment advices which are received based on each of the sort of, clearances which the government departments make. And therefore, if there is a periodic reconciliation, first I should be leveraging that periodic reconciliation from a controls perspective to even determine in terms of what kind of confirmations I should be sending to the government and what kind of alternate procedures I need to be performing. But there is no exemption in terms of not performing any procedures relating to existence.
Yeah. Maybe this one, Ma'am Chandrika, you can take. How can the auditors strike a balance between thoroughness and efficiency in their verification processes, particularly in industries with complex supply chains?
So I'm actually not very sure I understood the question, but on efficiency and
Thoroughness.
Efficiency, okay. Efficiency and thoroughness, okay. One, I would assume thoroughness to
How
be.
could an auditor strike a balance? Yeah. Somebody wants to know how can an auditor strike a balance between thoroughness and efficiency in a complex, supply chain industry. Yeah.
Is this, you want to go, Anand?
Yeah. So, let me take an example of a retail, right? It's practically impossible for the company to perform the entire reconciliation process in a retail industry closer to the year end. And therefore, the company relies on perpetual inventory system. The company relies on cycle counts. And therefore, the entire risk assessment relating to the perpetual inventory systems and the cycle counts and the design and operating effectiveness of that becomes really, really important, right? And how often are high value items tested? What does it contribute to the overall scheme of things? When do they essentially test each of this? Then becomes really important, right? For example, in an automotive industry, what I have seen is there's a big supply chain which is there, but generally all automotive clients test their inventory or physically verify the inventory at each quarter end, right? We as auditors have tested that. You would have seen this in an automotive industry. But the retail industry works a little bit differently, where there's a perpetual inventory count, there's a cycle count, the IT systems relating to that. How do we do it then becomes really important. So it's really a question of how do you do it. For example, let's assume if your perpetual inventory system and your cycle counts are not operating effectively, right? There is no possibility of you getting an assurance on the inventory account balance unless and until management tests inventory 100% closer to the year end, right? Because otherwise, you have a large balance which is not tested by management, and if they have not tested, there's no basis for you to go and test it then to that extent, right? So maybe if I understood the question, sir, correctly, I would bifurcate it by industry and try to stratify and do my testing.
Great. That's absolutely fantastic. Ma'am Chandrika, this one is for you. Would you do arm's length testing for related parties in a private limited company for which transfer pricing is not applicable and there's not much peer information available.
Yeah, so yeah, I guess this is because of the related party piece. Just to clarify, for starters, transfer pricing need not necessarily confirm arm's length pricing. That is purely only from a tax perspective, wherein it is one of the very many inputs, but need not necessarily be the only input. The question here, therefore, would be, what is the nature of the transaction itself with the related party, and why the related party? Was there a need for the company to transact with a related party, and had they transacted with another party, then would the pricing ever have been different? The question here is whether it's a private company or not a private company. The obligations of the board continues to be the same, except that you have additional approval mechanisms when the company is a listed company, that are 177 and SEBI obligations kick in. Otherwise, the obligations of the board continue, the obligations of the independent directors continue, in a sense that clearly evaluating as to what is the product, what is the transaction, whether the transaction needed to have happened. So it's just, we cannot go directly just to the pricing. We have to start with the why of the transaction before we get into looking at the pricing of the particular transaction. Oftentimes, what happens is, when you're actually entering into a transaction, which is a specialized one in nature, if it is going to be a generic one in nature, you might have enough pure information. But if it's going to be specialized, which is your question, where not much pure information is available, understanding the basis of that particular pricing becomes important. Oftentimes, a company would actually seek valuation reports in case of complex deals, complex transactions, and the other counterparty is a related party. There would be valuation reports which would underlie that particular transaction. That is one example. There could be many, many more. Therefore, to start with the why, go on to understand how the pricing stacked up. That would kind of give broad understanding in terms of what is it that the board did to come to the conclusion that the pricing was reasonable for them to enable them to transact. End of the day, it is protecting the interests of the stakeholders of the company. Whether the transaction is protecting the stakeholders of the company or not becomes the question to understand. There is another question for the same thing. Why and business rationale be sufficient and appropriate evidence? Business rationale, economic substance becomes absolutely critical. The answer to the question of why will then have, actually, it's asking those 5 whys to a transaction, which gets you to the answer as to whether it makes business sense or not, whether it makes economic substance or not, whether there is underlying business rationale or not. If you actually check all boxes to say the answer is no, then you're probably trampling on a 143.12.
I mean, to add on, Chandrika, there are. I mean, once a transaction is being sort of envisaged, there will always be determination in terms of what that arm's length pricing is going to be. For example, let's assume if who's the customer to whom you're giving, right? Even if it is a related party, whether he's sufficiently competent in terms of executing it, that's where the business rationale comes to, right? For example, is he an intermediary in the overall scheme of things? Who is the person actually executing this entire transaction, right? What is the price at which I am paying? Whether the commission I am paying as far as this is concerned makes sense or doesn't make sense, right? Once you start questioning why, including going back into the board meeting minutes, including going back into materials which are available with the company, right? And then including shareholders' approval and so on and so forth, there are a lot of answers which you would get automatically. And if you are not able to get it, right, there is always a escalation matrix within each of the firms which are auditing, who would essentially go and determine in terms of what an appropriate audit evidence is going to be.
Thank you very much, esteemed speakers, for taking the questions. I'm afraid, we have to stop somewhere. Otherwise, it may go on and on, right? So that brings me to, do the customary duty on my part. And I have the honor and privilege to extend a vote of thanks to our esteemed speakers. We extend our sincere gratitude to both of you for sparing your time and for being committed, to share your knowledge and expertise with the participants. We are extremely thankful to our executive body of NAFRA for their steadfast support in organizing this webinar. We extend our special thanks to our honorable chairperson for being instrumental in guiding this event. And we place on record our sincere gratitude to our secretary also, who has contributed, in planning this webinar series. On behalf of the executive body, I once again, thank both of you. It was great having both of you, and we look forward, to having you in such series, and in fact, having you here in person as well in our premises. I thank all the participants, for being there, for being active, and asking those relevant questions. And a big thanks to our NAFRA and MCA technical team, though I once again apologize for some technical, issues that cropped up. These are the pitfalls of depending on technology. We really apologize for that. I am grateful to Mr. Vidyadhar Kulkarni also, who is not with us today. He's gone to attend some court proceedings. So he's been instrumental in, putting up this webinar as well. We continue to, look forward to this knowledge sharing and professional growth, and invite all of you to our next webinar, which is on 14th of March, 2024. I now take this opportunity of, informing you all about our NAFRA International Conference that we are, excited about. And it's on 5th and 6th March at Bharat Mandapam, Delhi. I'm afraid the in-person registrations have closed. I would urge all the participants, however, to join online and take advantage of the keynote speakers and the luminaries who are going to grace the conference. Again, to those who could not make it to this webinar, we will be uploading the recording of this webinar on our website and our YouTube channel as well. So I thank both the speakers and all the participants once again for a memorable and a valuable, webinar today. Thank you very much.
Thank you, sir. Thank you.
Thank you. Bye-bye.
Thank you, sir.